What's up, mortgage pros? Austin Niemiec here, and welcome to more products, more options. Thanks for joining me on a beautiful summer, although summer's almost over, a summer Thursday. We got the NFL kicking off tonight, so it's the official end in my books of summer. But more products, more options. This is a huge focus of ours in the month of September. It's our main focus. Look, we're going to continue to provide you great interest rates, a great process, technology, your crews. But as the market shifts and changes, we know that diversifying, having more options, getting creative, getting unique is important. So we've been behind the scenes building new options and new products. So today, we're going to roll a new product out to you. We're going to talk about a few things as well that a lot of our top partners are having a lot of success with in this new market. And then keep your eyes peeled because we're not done. We're going to have several more new products roll out over the next couple of weeks as well. So stay tuned. But before we get into the product, I want to talk about this word, change. There's some buzzwords, I think, in the year 2022. Inflation is definitely, it might win word of the year, but change is a word you're hearing a lot about because there's a lot of it. Rates, they're changing. You know that. Values, inventory, lead flow. Your lead flow is changing. Lending partners are changing. Products are changing. And so you got to be able to embrace the change. And some people shy away from change. In fact, I think in our human nature, we shy away from change. But to succeed in this market, which there's a lot of folks out there doing big things, you got to love change. Now, we had a gentleman come and speak to our leadership group a couple months ago, and he had a quote that's just been ringing in my head. And I know many of you on this call have heard me. I've been preaching this quote, but this was one of the Jamaican bobsledders. If you're a 90s baby like myself, Cool Runnings was a big deal. But he gave us this quote, and this gentleman had to do and embrace change. I mean, he went from sprinting to bobsledding in Jamaica, which is a little bit of a change. But he gave us this quote. In times of change, learners inherit the earth, while the learned find themselves beautifully equipped to deal with a world that no longer exists. One more time. In times of change, the learners, folks that embrace change, learn new skills, learn new products, think about things differently. They're going to inherit the earth. But there's a lot of people, the learned, that think, hey, I'm just going to do what I've always done because I've always had a lot of success and there's no need to change. Well, they're going to find themselves beautifully equipped to deal with a world, to deal with a market, to deal with an industry that no longer exists. So we got about 4,000 people on this call, and that shows that you want to change. You want to learn. You want to embrace. So we appreciate that. But you got to embrace new products, different ways of selling, and we're going to help with that. Let's talk numbers. Numbers. 785 billion with a B. It's a big number. That number represents the amount of American credit card debt across America in June of 21, so a little over a year ago, nearing record levels. 887 billion with a B. That number represents American credit card debt in June of 22. So debt is at a near historic high, and it's growing. We've seen a 13% increase in credit card debt across America year over year. And when we look at a beautiful little chart here, we're seeing debt on the rise. You can see it peaked right at COVID. And then Americans started chipping away. They had some injection of cash. But the last couple months, especially last 6 months, we're starting to see credit cards rise, and we'll probably see a record, and I mean a record level here in the next few months. There's a lot of reasons why. You guys know things cost more money today than they ever have before because of inflation. The stimulus money is going away. Folks are finally getting out of their homes. They're taking the vacations and they're going and doing things that they haven't done over the last few years because of COVID. There's a lot of reasons why credit card debt is about to be at an all-time high. Now, there are two more numbers. We're talking numbers. 15%. It's a large number. That represents the average interest rate on credit card debt right now out there in America. The number to the right of that, 21%, it's bigger than 15. That represents the average rate on new credit cards available today. And if you look, a big spike. As rates go up and as the Fed raises rates, well, guess what? Not only are mortgage rates impacted, so are credit card rates. And that right there is a hockey stick growth in credit card rates. So these aren't exciting things to talk about. We have historic credit card debt, and it's only on the rise. We have historically high credit card interest rates, and it's only on the rise. However, every dark cloud, this picture represents a dark cloud with a silver lining. Every dark cloud has a silver lining. And the beautiful thing is what we do can be that silver lining for Americans. And the product we're going to talk about today can be that silver lining for Americans as well. Because let's pivot to the positivity. This is a really big number. We were talking billions a minute ago. 27.8 with a T represents trillion. That number, 27.8 trillion, is the amount of equity sitting in homes right now, untapped equity in Americans' homes today, 27.8 trillion. So we talked about 887 billion in debt, 27.8 trillion in equity. It's a record level. It's never been higher. $185,000. This number represents the average equity in an individual American's home today. Think about that. The majority of an American's net worth is sitting $185,000 on average, sitting untapped in their home. So to recap, there's a lot going on. Record credit card debt, many reasons for it. Record levels of credit card interest rates, but record levels of equity. So our new home equity loan that we're rolling out, now this is going to be live in the next few weeks, but we wanted to get ahead of it. Some of the feedback we've gotten from partners is, hey, let's talk about the products you're rolling out a little bit earlier so we can ask questions. We can train ourselves up. We can start talking about it with our clients. So that's what we're doing. I'm going to walk you through our new home equity loan. It's going to be live in the next few weeks. We'll give you a go live date once we're close. We're prepping it. It's almost ready. But I'm going to go over some basic things. Some of you guys might know. Then I'm going to dive into some of the details. Then we're going to talk about a few other things. So our new home equity loan. I'm going to say it again, loan, not a line. We're rolling out a home equity loan. So what is it? It's a fixed rate, one-time draw, second mortgage. It's going to allow your clients to borrow against that record level equity we just talked about and receive a lump sum payment at closing. So what it's not a refi, it's not a line of credit, and it's not a loan with a variable interest rate, which is nice. So again, fixed, one-time draw, second mortgage, allows your borrowers to tap into that record level equity and get that lump sum at the closing table. Now, we talked about home equity lines internally. We talked about home equity loans. Who knows? Maybe we'll roll out a line. We want to start with a home equity loan based off of your feedback. You guys know your pros. Home equity lines of credit. Some of the negative is, folks can get overextended on them. They're also variable interest rates in a rising rate environment. Doesn't bode well. And of course, the payments on them adjust as well. Where the loan that we're rolling out, the home equity loan, it's a fixed draw, it's a fixed rate, and it's a fixed monthly payment, which is nice. Now, before we get into the details, let's talk about the best clients, because you guys are talking to clients all day long. You're marketing to clients all day long, and there's all different types of clients. So when you're thinking about this loan, who would it fit best for? The picture on the left is a beautiful machine. We're all very close to this machine. If you're a mortgage pro, this machine makes you feel good. The Qualifier Plus, there's a lot of versions. I got a really big one sitting on my other desk, but this machine has created a lot of wealth for loan officers over the last couple of years. And this machine has done a lot of the work for us, in my opinion. And what I mean by that is the rate and term refi that this machine calculates. Loan amount, payment, term, interest versus new loan amount, payment, term, interest. Taking someone from a 5 down to a 3, save them $250 a month, and then moving on to the next client. We've been blessed over the last couple of years with the majority of the business out there, rate and term refi. We've been dealing with equations. That world no longer exists. The rate and term refi is pretty much extinct. And so we got to get out of the mindset. I know a lot of you are, but put that qualifier plus down, put it to the side for a little bit, because the loans are no longer in the calculator. The loans are now a story problem, and you got to get creative, and you got to ask questions, and you got to go deep. Put the mortgage aside, put the rate aside, go into that credit report. That is where the gold is. If I was an LO for a very long time, this is a market. Pull up the credit report. Talk about every single debt. Mr. or Mrs. Client, the credit card with Chase. Looks like you've had it since 2005. Let's talk about it. Why did you take it out? What was the biggest draws for what happened in your life? What's the rate on it? It says the minimum payment here is $200. What do you typically pay on it? What's the strategy to get this credit card paid down? Let's talk about the student loan. Where'd you go to college? Did you like it? Do you enjoy it? How long have you had it out? What's the rate? What do you typically pay on it? What's the strategy to pay it off? I see there's a construction loan or a personal loan you took out 3 years ago. Talk to me about it. What'd you do to the house? The stories, the solutions, all of it's in the credit report. Pull them up early. Talk about them often. Go deep. But don't stop there. Again, story problem. What other factors are there? Talk about their assets. Don't be shy. How much do they have in checking? How much do they have in savings? What does their 401 look like? Do they have any other investments? Every single month, once all of your expenses are paid, how much are you able to put aside? Go deep. Assets, credit. That is where the loans are at today outside of purchase. So put the calculator down. We're no longer in an equation world. We are in a story problem world. You got to go get those factors and be patient. So once you've done that, you're going to find out a lot. Again, sticking with the theme of who's the ideal client. You're going to find out a lot of things that someone may leverage this product for. Pay down education expenses, pay off or consolidate credit card debt, fund a vacation. A lot of people are looking to do that. Been stuck in our houses for quite some time. Fund a vacation, pay for a wedding, start a business, pay for home improvements. A lot of folks are staying in the home now. Inventory's light. It's a competitive market. Pay for improvements, pay for medical expenses, make key purchases, fund investments, have an emergency fund. Now, these are the things that you're going to dig up. People aren't calling us. If you're buying leads or you're buying credit triggers, they're not calling you saying, hey, I have an emotional event in my life. I need cash, and here's what I need it for. You got to pull that stuff out of it. The other reason I wanted to show you this slide is because when you're marketing this product, don't just say, hey, I have a home equity loan. Talk about, are you looking to start a business? Are you looking to go on vacation? Do you have high interest credit card debt that's nagging at you, that's sticking around? So not only are these reasons clients may want to leverage this new loan, but these are also things you should be marketing, selling, and baking into your marketing as well. So those are the ideal clients. Now, what is the benefit of this new home equity loan that we're giving you guys? Well, there's some benefits to you. And again, most of you probably know this, but to recap, you as a LO, as a loan originator, as a broker, first benefit is you're going to increase your conversion, obviously. I'm sure many of you have been having conversations with clients that actually need and want to tap into their equity, but they have a 3% on a 30-year fix or a 3.5 or a 2.99 on a 15-year fix, and they don't want to disrupt the beautiful rate they have on their mortgage. Well, guess what? Now you have an option. You're going to increase conversion. Next, extend your reach. We just talked about it. You're going to have something new and fresh to market, whether it's social, mailers, or talk about to referral networks, financial advisors, insurance agents. So it's going to allow you to extend your reach and talk about something new. Now, a lot of us want to nurture our book of business. And again, our past closed clients, our book of business, most of them have very, very low interest rates. So maybe you're shying away from even marketing or nurturing those clients because you're not sure you have a lot to talk about with rates being in the 5s. Well, guess what? Now you have something new, something fresh to message, new solutions to your book. Get out ahead of them. And last but not least, retention. Look, if someone's got a 4%, you don't want to touch it, it's okay. But you give them 150 grand on a home equity loan to help solve their problems today. When rates go down, of course, it provides an incredible opportunity to go back and have repeat business with the consolidation of those two loans and retain your book of business. So benefits for you. Now I want to pause and I want to take a commercial break for a moment. So I've been having a lot of conversations with brokers and a lot of people are excited about this. But some brokers say, man, if I'm doing a $75,000 home equity loan and my comp set at 1.5%, is it worth my time? And I challenge everybody. It is worth your time. Right now, we got a little bit more time on our hands with production across America being down. But even doing a loan for free, and by the way, you're going to make some good money on this, but even doing a loan for free, it allows you to stay in touch, retain, keep these folks in your network, because there will be another time where rates drop and you're going to make a lot of hay. The sun will be shining, but also purchases. The more you're transacting and touching these clients, even on smaller loan amounts, it's worth it for the long health of your business. All right. Benefits for the borrowers. That was for you. Benefits for the borrowers. Achievement. Again, you're going to help Americans do some pretty cool stuff with this loan. Pay expenses, consolidate debt, remodel their house, go on vacation. Savings. Funding. This is typically a much lower interest rate than a 15 to 20% credit card or a 12% personal loan. Security. Again, folks are going to be able to tap in and leverage while keeping their first mortgage intact. And then stability, it's fixed rate. It's a fixed predictable payment. So there's a lot of benefits to the borrowers, you know. So let's talk about the details, the product highlights. It's important you know this thing inside and out. So I'm going to go over the details here. This slide's sponsored by Pathfinder. My opinion, one of the strongest technology tools in all of the industry. You guys know it. You love it. Pathfinder. This will be live in Pathfinder soon. Your account executive will let you know when all the product details for this new home equity loan are live in Pathfinder. But let's go over it now. The minimum loan amount, $45,000 on this new home equity loan. The maximum, they're thick. You can go to $350,000 on the home equity loan. So when we look across all the kind of products out there when it comes to lines and loans, it's nice, $350,000. This is another great advantage. We're going to be able to take this max LTV, CLTV, HCLTV all the way up to 90%. Again, when we look at home equity loans across the industry, most of them are at 80. There's a few that are at 85. We're going to be able to go all the way up to 90 on this one, which is very nice win. We also have some diversity in this product. We can have a 10-year or a 20-year fix. So it's going to give you some optionality to present, again, fixed term. So again, most of these are variable. This is fixed. Most of them are at 80 to 85. This goes up to 90. We go all the way up to 350,000 on these. Occupancy, again, some diversity here. We can do this on a primary home, but we can also do these on second homes as well. Property types, single family, but we can also extend it out to a condo and PUDs. DTI, we can go all the way up to 45%. And the appraisal is just a normal full appraisal. We'll probably be working towards an AVM here as we innovate this product down the road, but it'll be a normal appraisal. Now, version 1.0, we're not doing piggybacks. So this will be a lump sum at closing, again, fixed up to 90%, up to 350. No piggybacks on version 1.0. Okay, probably wondering, how do I get paid? How does the compensation work? We love the way we have this structured for you. We know there's other products out there that you have to expose your compensation to the borrower no matter what. I know there's a lot of different lines or home equity loans out there, but most of them, when we look across the landscape, you got to reveal your compensation regardless. And on a $50,000 or $150,000 loan, you know, exposing a 2 to 3% comp creates some conversations you have to have with the borrower. The beautiful thing about this, the compensation works exactly the way it works today with us on any normal loan. So standard, whatever you have your comp set up at today with us is how it works here. So you can go lender paid and it's static. If you're at 2%, it's baked in, it's not exposed. Or if you want to flip it to borrower paid, you can flip it to borrower paid. So again, incredibly simple. Comp works the exact same as where you're at today. You can go all the way up to 275 if that's how you have your comp plan set up as. You can go lender paid, you can go borrower paid, and you don't have to expose the comp like most every other home equity loan out there, which is nice. Okay, let's talk about the process, because look, had a lot of brokers reach out and say, when are you going to get a second? I really want a second. I said, well, look, we're building it right now, but there are some other lenders out there that do home equity loans and lines. So in the meantime, go leverage those folks. The common theme I'm hearing though is, hey, look, it's a pain. Doing some of these home equity loans with these niche lenders, they have them, but it's a 2, 3, 4 month process. The technology is not good. In fact, sometimes it's doing more harm for me, putting my clients to this experience than it is good. And so I would love for you guys to roll out a home equity loan and have it look and feel and be on your same portal and the same process with the crews and the visibility and Rocket Connect. And so the nice thing is the process, it's going to feel exactly, almost identical to a normal loan. There isn't caveats or hoops or extra things you got to do on this. And so it's simple. When this is live, and again, we'll communicate when it is, you'll just go right in. You can price it out. It's baked right into our pricing tool. And then when you're ready to rock and roll, you go right into our portal and start a new loan. And it's the exact same experience that you're used to today. So you'll go down to the product group, as you can see on your screen. You'll click home equity loan. You'll have the 20-year there option. You'll have the 10-year option. And then everything's the same. The only tiny nuance is you're going to get all the way up to clear choice findings, and you're not going to run findings. It'll let you know if there's any stoppers for maybe DTI, but you don't need to run findings on it. You'll register. You'll disclose the exact same way. We got your back with the disclosures. There's a few added disclosures, but we got it. It's built in. You'll disclose to the borrower. They'll go right onto the client portal per usual. E-sign, upload. Again, everything's identical. The visibility, the Rocket Connect, all the way up to closing, everything. These loans will go through your same crew with your same crew leader, your same underwriter. So the experience will feel, look, act the same. Your compensation will feel, look, act the same. The turn times on these things will look, feel, act the same. You're not going to have to learn a new process or teach your processors or LOs a new process. So very, very familiar for you, right on our tech platform. Okay, some frequently asked questions that we have. Does the client have to have a first mortgage? Yes, this is a second lien. So if the client owns the home free and clear, you would just do a first cash out mortgage. So the client does have to have a first mortgage, which I'm sure most of you know that. Is this offered in all 50 states? It's offered in 49 of the 50 states, every state excluding Texas, based off of some of the cash out nuanced guidelines, which I'm sure most of you are familiar with in the great state of Texas. Do we offer on correspondent loans? Version 1.0, no. As you know, there's a lot more doc work that needs to be done. The good news is if you're a correspondent partner of ours, set up hybrid, which every one of our correspondent partners are. If you're hybrid, then you would just disclose this and leverage our wholesale platform while you're doing your other loans core. But leveraging a home equity loan version 1.0, we're not doing through the correspondent channel yet. We talked about piggybacks not being allowed on version 1.0 already. Are there prepayment penalties? No, there are no prepayment penalties on this loan for the consumer. EPOs, identical, 180 days. So very, very standard to how it works today. Now, for our Pinnacle partners, we waive all of your EPOs for you. We won't be waiving EPOs on the home equity loan. I'm sure all of you know this loan is apt to pay off faster. Folks could take the cash and say, you know what, I don't need it, and pay it right off. It's not like a first lien. And so to avoid that, and because these things do pay off faster, we're not going to be waiving EPOs if there are any for our Pinnacle partners, but the standard 180-day EPO. Okay, last but not least, you go into Pathfinder, we have our debt consolidation calculator. If I'm you, I'm leveraging this when presenting and painting vision on this new product. So you'll be able to go in, and I got an example here. Let's say it's a $100,000 home equity loan. You picked a 20-year term. Let's say the rate you pick's 9%. You got a new payment of $899, but you're paying off 3 cards. Credit card one's at 15%, $30,000 balance, 2, 20 grand at 13, and then they got a personal loan for 40 at 10. That's $90,000 of debt you're paying off. In this example, you're giving them an extra 10 grand. So it breaks it down. Old new payment, $899. The blended rate on everything you're paying off is 12.5 today. The new rate's 9. So not only are you saving them 3.5% on their blended rate, you're freeing up $280 of cash flow, and you're giving them an extra $10,000. So again, we built out the debt consolidation tool in Pathfinder. Go in there, search it, and I would be leveraging this when presenting our new home equity loan. So we're excited about it. Your AEs are trained up. So if you have any questions, call them. We wanted to get ahead of it. Again, this product will be rolling out over the next couple of weeks. The second it's live, we're going to let you know. But we wanted to get it out ahead of time, so you guys can ask questions and prepare on how to leverage it. So, home equity loan. Now, a couple other things. If you didn't see it, want to make sure you see it. Conforming loan limits. We took them up. We took them up pretty significantly. We took them up about 11%. Now, a reminder, we were first to market. A few weeks back, we said, let's get this thing out. Let's do this and stretch this more than we ever have before. Fannie and Freddie aren't going to announce their 2023 loan limits until probably the end of November. So we're over 2 months ahead of time. But we said, hey, how do we make a splash for our broker partners? How do we give you something to market? How do we give you something to differentiate with real estate agents? How do we give you something to go get a little bit larger loan amounts or save some loans or win a deal over another broker or lender? And so we did it. We built the tech, we got it going, and we were the first out of any lender in the whole United States of America to launch this for you. So just to recap, and this is live on all new registrations and all new locks. As you can see, we took the conforming, again, Fannie and Freddie, from 647.2 up to 715. So like an 11% increase from where we're at today and where other lenders are still sitting at today. Now, commercial break. In November, Fannie and Freddie might come out. It could be higher as well. We're being maybe just a tad conservative at 715, but if they come in higher, great. These will be even higher. But 715 on one unit, 916 on two, 1.1 mil on three, and then almost 1.4 on 4-unit properties. So it's live on all new regis. Get in there, price loans out, and leverage it. I would also, if I'm you, go back and look at loans that maybe you didn't convert, maybe fell out, loans you're still presenting that are cash out that need to get more. Go back, do a sort. I think the old limit was at, again, 647. Sort anything in your CRM between 647 and that 715. Get in there. Same thing with pre-approvals. If you have pre-approvals sitting out there right now, maxed out at that old 647, call them back. Give them the good news. Get another touch point to talk about and just provide value and benefits. So I'd be searching anything that's a pre-approval, search anything you presented that you didn't convert, and search anything that you're waiting on that you could have a competitive advantage. So live in the portal, take advantage of it. All right, last thing I want to talk about is credit upgrade. It used to be called Fresh Start. We rebranded it. This has been an awesome, and I thought 6-7 months ago, an underutilized tool that we give our Pinnacle partners. Just to recap, credit upgrade. It is your own dedicated credit repair specialists that are an extension of your business. So we have an entire team led by an incredible leader that's working with the best credit repair technology in the industry that are at your service. You have a client, you need to get their credit up, send it over to the team. They'll find the fastest, easiest, most cost-effective way to do it. We'll collect the docs. We'll do the rescore. This is all free service for you, and we'll serve it back up to you on a golden platter. Now, over the last 3 months, as the market shifted, and you got to get creative. Again, in times of change, learners, learning new things, trying new things. We've seen the amount of brokers leverage credit upgrade over the last 3 months go to levels we have never seen before. And we're seeing folks win business in a time where winning in the inches and conversion really, really matters. But we also see some partners who aren't leveraging this at all, bigger partners too. So I want to recap a couple of things, because if you're not taking advantage of credit upgrade in this market today as a Pinnacle partner, you got to do it. So a couple of things. When I think about it, put myself in the shoes of you as a broker. When would I leverage credit upgrade? I would leverage credit upgrade on every single pre-approval I have. You know, pre-approval, sometimes you pre-approve a borrower, and it takes them 1, 2, 3 months to find a house. You got to find relevant reasons to stick with that borrower without bugging them, providing them value. You also know that in that 1, 2, 3 months, they're pre-approved, they're shopping you. Everybody's shopping. Credit triggers, all sorts of stuff. If I am you, I'm sending every pre-approval I have to credit upgrade. Why? If they're at a 735, get them to a 741. If they're at a 620, get them to a 680. If they're at a 705, get them to the next pricing tier, to a 720. It also makes sure the client feels like they're already working with you, because with credit upgrade, they're communicating, they're sending in documentation. They want to have the most purchasing power when they go to make the offer. And if they're already sending you docs and we're already increasing their score and we're already providing value, you will convert these pre-approvals at a much higher clip. So leverage it. Even if their credit's good, take it to great. If their credit's great, take it to amazing. Next, an obvious one, high LTV cash out. Most refis out there, and there's a lot of refis still happening, but it's cash out. You know, the high LTV cash out to 75%, to 80%. If you got someone under that 740 FICO, they're getting dinged. They're getting hit. You know, you're looking at cash out below 700 at 80%. I mean, there's several LLPAs for it. That could be the difference between $4,000, $5,000, $6,000 in costs. Send them to credit upgrade. We can eliminate significant costs. It could be the difference between the loan making sense or not making sense. It'll be the dip between you being the obvious choice from a pricing perspective versus competition. So high LTV, cash out, you got to send it to credit upgrade. Govy less than 640, you know the clients are getting dinged up from a pricing perspective. Get it over. Our team will do everything they can to get over that 640 mark. And then fallout. If you've had fallout over the last 6 months, year, 2 years, maybe a value came in low and based off the credit, the loan fell out, go back and sort your fallout. If any reason was because of credit, get it over to credit upgrade. We can turn a no into a yes. Here's my favorite part about credit upgrade. When you take an American family's credit score and you increase that score and you save them $2,000, $3,000 on their mortgage, that's a beautiful thing. But also, if you take someone from a 680 FICO to a 720 or a 740, that's not just going to help them on the mortgage and help their rate be a little bit better and their cost be better, but you're helping them in many more ways. When they go to get a credit card, guess what? You saved them money. When they go to get an auto loan, you saved them money by taking their credit up. It's going to create lifetime love. Everyone looks at their credit score as part of them. It's their part of their financial soul. And if you can take that and make it healthier and save them money, but fix it for the long term, you're going to have lifetime love and you're going to get more referrals. When you say, hey, I took you from a 680 to a 720 and they're excited and ecstatic, ask for a referral. Ask who else you can help out. It's big time value. It's a differentiator. It's a free service. It's amazing. Now, I want to provide a couple examples. One of the things our account executives do on a daily basis is they share with each other. They share success stories. We got great email chains going where our A's are saying, hey, I helped a broker partner win business doing this. And then we try to share best practices. I collected a few I saw come through. This is just within the last 2 weeks about success stories our brokers had with credit upgrade. I want to share it because I want you to ensure you know how effective this tool is. Here's one, credit upgrade. Just jumped a borrower's credit score from 634 to 740. Yes, 106-point jump. This resulted in 6 pricing tier improvements on a $554,000 purchase loan in a matter of 9 days. Total savings for the client origination cost was $18,350 with lower BPMI and lower LLPAs. The loan level pricing adjustments went from 3.25 down to 1/4, 0.25, and the BPMI cut in half. Think about that. That client's going nowhere. The credit trigger companies that are calling, they're going nowhere. That is a borrower, a client for life. They will never use another mortgage company ever, period, if you do something like that for them. A 634, low, D grade credit, not only for the mortgage, but for everything else, up to a 740. almost 20 grand in savings in 9 days. Sometimes people think, man, credit repair is like a 3-month process. We did it in 9 days. These are pros, our credit upgrade team. They have tech. They're giving you an answer in like 10 minutes. And we're doing the work and we're doing the rescore. We can even collect the docs if you want. So it's very, very low lift for you, very, very high impact. A few more. Credit upgrade just helped one of my partners win a competitive purchase loan. We jumped the score 38 points from 709 to 747. That's 2 pricing tiers, 75 bips on a $416,000 loan amount, cost savings of $3,100. I had a cash out refi where a client was getting crushed by pricing adjustments because FICO is 665 at a high LTV, like we were talking about earlier. Credit upgrade took them to a 702 in 8 days. 8 days, wiping out 1.25 point in hits, saving them over $6 grand cost, big win. Borrower for life, referrals all day. You're not going to lose that client in process to folks soliciting them. It's a win, and it's such a light lift. I'm going to be repetitive. Such a light lift for you. So leverage it. So again, 3 things. Home equity loan, it's coming. Next couple of weeks, we wanted to get ahead of it. I think it's a very, very nice win for you. Even if you're making a small amount of money on these, if it's a small loan, do it. Keep them in the ecosystem. Keep as many clients in your ecosystem. It's worth the time. But again, we can go to 350 on these. So there's definitely money to be made and a lot of human beings to help. Conventional loan limits, they went up in a very nice way. Big competitive advantage. You're one of the only ones that can leverage it, being that we're first to market. Make sure you understand it. It's live in the portal, all new Reggies. And credit upgrade, underutilized tool, in my opinion, with big value and a light lift. Pinnacle partners take advantage. If you're not a Pinnacle partner on this call, get with your AE, figure out a plan to get to a path to Pinnacle. All right. I want to end with this. 2 words. I was thinking about driving in this morning, the message I wanted to deliver to our partners. It's a picture of a ship in a rough sea. And this market is rough. We are in a cyclical business. We know that. Rates go up, rates go down. It's the life we live and the life we choose and the career we've chosen. This cycle's different. You know that. It's a little bit different than other cycles. Going from a $4.2 trillion market, one of the most bountiful, blessed markets we've ever seen over the last few years. And within just a few months, seeing it get cut in half down to probably less than 2 trillion, 4.2 trillion market to a 1.9-ish trillion market. Those are some rough waters. And you're seeing it impact the industry. And you're a broker. And your biggest advantage, is all of these lenders serving you, fighting for your business, doing everything we can to be the obvious choice. And you're seeing lenders step out of the game. Big lenders step out of the game and get out. You're seeing other lenders, maybe not get out of wholesale, but kind of stop maybe investing in it, which it's not great for you. And we don't celebrate that here. We understand choice and optionality is your superpower, and we love to compete. But I wanted to end with this. We give you 2 things, stability and commitment. We are different than most lenders. When I look at the diversity of our company, we have retail. Some lenders will say that's not a good thing for you as a broker. My opinion, it's the best possible thing for you as a broker because it gives us diversity and it gives us balance. So we have retail, we have wholesale, we have auto, we have loans, we have all sorts of diverse arms of our company that allow us to be stable and get through these rough waters. Every mortgage company, including us, is impacted by these rough waters. But we know that our stability can be a great advantage to you as a broker community. Now, just because you're stable doesn't mean you have to be committed. But I'll tell you this, we've never been more committed to the broker community, period. It'd be very easy to lean out or maybe trim back on how we're investing for you. I will tell you this, we've never been working harder. We've never been more focused. And you're going to see, we got home equity loan coming, but we got more products coming. And they're going to be coming quick. We're dedicating and investing into tech like we never have before. You see it, you feel it with our crews. providing you with some of our most talented teams of underwriters and dedication to you. So stability, you got it. Commitment, you better believe you got it. We'll continue to work our tail ends off for you. We can't thank you guys enough for the partnership. Keep doing big things. Learners will inherit the earth, and keep your eyes peeled. We got more coming to you. Appreciate y'all, and have a big day.